Hi friends, welcome to eConcept. Today we will discuss what is depreciation and we will discuss different methods to calculate the depreciation amount of an asset with solved examples. So first we will know that what is depreciation. Depreciation is a permanent fall in the value of fixed asset arising through wear and tear from the use of those assets in business. So it's a permanent fall in the monetary value of fixed asset. So what are the fixed assets? Assets are those assets which are not easily convertible into monetary values or cash. For example, if you have purchased any machine, that is your fixed asset or your building. So I will give you a very simple example. For example, if you purchase a machine for 1 million dollar or 1 million rupees or any currency, then it's quite possible after 5 years the value of that machine is zero point 0.1 million or 0.05 million. So with time the monetary value decreases or financial position of that machine decreases with time. So that will be depreciated amount over time. So what are the causes behind depreciation? They include internal causes and external causes. There could be wear and tear in the equipment, and by that it can lose its monetary value or financial value. Disuse, maintenance issues. If there are maintenance issues in the equipment, restriction in production. If there is no use of that machine in the production, reduced demand, technical progress. There could be some other advanced solution available in the market. So you can replace that machine or that asset with advanced assets. So what are the external causes? Obsolescence and reflection of time. Of course, we know the product life cycle of any technology or an asset. So with time, things do obsolete. Technologies do obsolete. So these are the internal and external causes for depreciation. So what are the objectives to find depreciation? It is fine to calculate the proper profit. Okay. It shows the asset at its reasonable value or true financial position in the company books. It provides replacement of an asset if we want to replace that asset with an advanced status, but we must know that what this asset has value right now. To correct cost of production, this is the first point to calculate the proper profit, and the fourth point to correct cost of production all are almost same. Depreciation is permitted to be deducted from proper profit for tax purposes. So these are 5 methods that we are going to discuss with solved examples. Straight line method, declining balance method, sum of the year digit method, production unit method, and modified accelerated cost recovery system. So what factors do we need to calculate the depreciation amount? We need total cost of asset. We must know it before we solve the example. Total cost of asset when it was purchased. Estimated useful service life. It could be 1 year, 2 year, 5 year or 10 year. Estimated salvage value. When that useful life is gone, for example, if a equipment has service life of 5 year and then 5 years are over, then the value of that asset in the market or its monetary position or its financial value, that will be estimated salvage value or residual value, and after that there will be no decrease in its value, its salvage value. It's a fixed one. So first we will discuss tail end method. This method says that the same amount of depreciation is charged every year throughout the life of the asset. For example, if we purchase an asset for 10,000, so after 1 year its amount depreciated is 1000, and it was a beginning year. The book value of that asset in the beginning of the year for year 1, and this is the book value at the end of the year 1. So we can minus 1000 from 10,000 and we will have answer 9,000. So the end value, the book value at the end of the year 1 will be the beginning book value at the start of the year 2, 9,000. So again for second year it is again reduced its monetary value or financial value by 1000. So again we will have 8,000, and that 8,000 will be the beginning book value for year 3, and that will be 8,000. So the process continues. Here we have a very simple example. A company named ABC purchases a machine for $60,000. It has an estimated salvage value of 10,000. Means after useful life, and what is its useful life? That is 5 years. After 5 years, it has estimated salvage value of 10,000 in the market, or its financial position is 10,000. It has reduced from 60,000 to 10,000. company want to calculate the annual straight line depreciation for the machine. So what we have total depreciation amount that is $60,000, and if we minus estimated salvage value from 60,000, actually 60,000, 10 is missing, so we will have $50,000. So this amount has been depreciated with time over 5 years. So in this method, we will actually in every method we will have to find, or we must know, a depreciation rate. So in this method we have a depreciation rate 20%. How did we calculate this depreciation rate? Actually we had the useful service life for 5 years. So what percentage of equipment has reduced for year 1, and that will be 1 over 5 multiply by 100, we will have a percentage. So and depreciation rate is 20%. Even we know, if we review the figure thoroughly, we can see that for 5 years it has reduced value 50,000. So for 1 year it will be 10,000. Okay. So annual depreciation, we will multiply the depreciation rate with 50,000, the total amount depreciated, and that will be 10,000 annual depreciation. So this is our example of. Or if we see it in another way, if we have a useful life for is 8 years, then what will be the depreciation rate? It will be 1 over 8 into 100, and that is 12.5%. 1 over 8 are the total useful years. So 12.5. And what will be the annual depreciation? 0.125, its digital value, multiplied by 50,000, and that will be $6250. So now we have declining balance method of depreciation. It says that many plant assets depreciate more in the early years of useful life than in the later years. Charging more depreciation expense in the early years may be more accurate than charging the same amount each year. We have charged the same amount each year in this method, but in this method we will charge more amount in the early years of useful life. We see if in engineering we see there is a bathtub curve, and it says that when you purchase an asset, it depreciates, or it loses its monetary value in the very first years in a speedy way, and then it gets a constant curve. So how can we calculate it? Multiplying the book value at the end of each fiscal period by a constant depreciation rate is called the declining balance method of depreciation. So we will have a constant depreciation rate, but that depreciation rate will be double of what we calculated in straight line method. So it is also called double declining balance method of depreciation. So the very same way we will calculate the depreciation rate, but then we will multiply it by 2 because it is twice the straight line rate. So here we have the example. The company purchased a computer for $2,000, and it has a useful service life of 5 years and estimated salvage value of $175. So you know what is salvage value. After 5 years, the value of that computer in the market is $175. So we have the data here. We have the beginning book value $2,000. Okay. So the beginning book value in this case will be the purchase value of the asset, and we have declining balance rate 40%, and we will multiply this for 40% in with 2000, and then we have annual depreciation 800. 800 will be minus from 2000, and the ending book value for the year 1 will be 1200, and this value will be the starting book value, beginning book value for year 2, and same the process continues. So now how we calculate this 40% declining balance rate? We had estimated useful life 5 years. Straight line method says that the percentage will be, the depreciation rate will be 1 over 5 into 100. Exactly how we calculated it in this example, 20%. But we have said that the in declining balance method, it is double of straight line method. So we will multiply it by 2. So declining balance rate will be 40%. So here it is 40%. So I will again repeat that you multiply 40% with 20,000. Okay, and here we calculate it. Beginning book value is $2,000. Depreciation rate is 40%. Annual depreciation will be 0.4. The digital value of 40% multiplied by 2000, and that will be 800. This will be minus from 2000, and we will have $1,200. $84, and that ending book value for year 1 will be the beginning book value for year 2, and the process continues with same. But there is a concept here, because 40% of 259, the 40% of 432 is 172, the 40% of 720 is 288, that is okay. But the 40% of 259 is not 84, it is 103, $103. But why did we write it $84? Because the annual depreciation or the total depreciation is $1825, because the estimated salvage value is $175, and why we will, when we have it minus from $2000, the answer will be 1825. So this is the total depreciated amount, and the equipment or any asset can't be depreciated any further above this amount. It could not be 1850 or any other value. So whatever the case is here, whatever the value is here, we will put the that amount that will total the sum of the total whole 5 values will be 1825. So it is 84. So now sum of the year digit method. Here is the theory. It is very simple. You can review it by yourself, but we will clear the concept from the example. Here we have the example. We have the same data, but we have 5 years here estimated useful life, as we have in the previous example. But here we have calculated the fraction. We have 5 years useful life. So first we will add these 5 years, addition of year digit. So it is called sum of the year digits. So what are the sum of the year digits? 1 plus 2 plus 3 plus 4 plus 5, it is equal to 15. And what are the fractions? 5 over 15, 4 over 15, 3 over 15, 2 over 15, and 1 over 15. This fraction has minimum value, and that will be used for year 1. This will be used for year 2, this will be used for year 3, and this will be used for year 4, and so on. So we have fraction 5 over 15, 4 over 15 for year 2, for year 3 we have 3 over 15. But in this case, we don't multiply this fraction with beginning book value. We have total depreciation amount, then that is $1825. We will every time multiply this fraction with this value, okay, and then we will have an annual depreciation, but we will minus this depreciation from beginning book value. So this is the difference from previous method. We have fraction, constant fractions, and we have constant depreciation amount, and we will multiply these two. And again the procedure is very simple. What will be the annual depreciation? $608, and that will be minus from $2000, and we have the ending book value $1391, and that ending book value will be the beginning book value for second year. And in second year we have $905 ending book value, and that will be the beginning book value of year 3. So how did we calculate the depreciation amount, annual depreciation for year 1? We have original cost $2000, we have estimated salvage value $175, estimated total depreciation is 2000 minus 175, where that is $1825. Okay, here's fraction for year 1. What is that? It is 5 over 15. So what will be the annual depreciation? 5 over 15 into 1825, and that will be $608. So this is our the sum of the year digit method of depreciation. Now we will have comparison of 3 depreciation methods. We will see that the 3 values are same. For double declining method, sum of the year digit method, and straight line method. We didn't calculate this example for straight line method, and you can calculate easily uh, if you know the concept that we previously discussed. Okay, we find it right now. We have original cost $2000 and $175. So what will be the depreciation amount? That will be 175 minus $2000 minus 175, and that will be $1825. So what will be the depreciation rate for straight line method? It will be 20%, as we calculate. In this example 20%. Okay, 1 over 5 into 100%, 20%. So 20 multiply 20% with $1825, and we will have $365. Simple is that. And again for because straight line method, for every year there is constant amount of depreciation, so $365, $365, $365, and that will make $1825 for year 5, total year 5. So now we will discuss production unit method of depreciation. Sometimes the useful life of a plant asset depends upon how much the asset is used. We could have two automobile, and one automobile is driven 90,000 miles and other automobiles is driven only 20,000 miles for year 1. So the wear and tear will be more in that automobile that had traveled 90,000 miles because it traveled more. So this is a concept in production unit method of depreciation. For example, automobile will wear out faster if it is driven 80,000 miles a year rather than 60,000 miles. Calculating estimated annual depreciation expense based on the amount of production expected from a plant asset is called the production unit method of depreciation. The depreciation rate of the asset is calculated by dividing the estimated total depreciation expense by the estimated useful life. So we'll review the example here. We have a truck. The method is production unit method. Original cost is $18,200 and estimated salvage value is $2,000. So what will be the total depreciated amount? Get this $2,000 minus from $18,200 and that will be $16,200 total amount of depreciated. That is very simple, and it has a useful life of 90,000 miles, and its depreciation rate is 0.18 per mile driven. How did we calculate this depreciation rate? Original cost is $18,200. Estimated salvage value was $2,000. So total depreciation cost was 2,000 minus from $18,200. So that will be $16,200. And estimated useful life was 90,000 miles. So what was the depreciation rate? This the total depreciation amount that have consumed for 5 years divided by total miles that it traveled in 5 years. Okay, or just for 5 years. So that will be our depreciation rate. It is very simple. So here we have the example. So we have the beginning book value $18,200, and for year 1 the automobile was or the truck was driven for 9,000 miles. So what will be the annual depreciation? It will be 9,000 multiplied by 0.18. Then that is our depreciation rate, and answer will be $1620. $1,620. We will minus this 1,620 from 18,200 and we will have answer $16,580 ending book value for year 1, and this ending book value will be the beginning book value for year 2, and so on the procedure continues. But here we have a difference that the miles driven are different for each year. For year 1 it was driven 9,000, for year 2 it was driven 23,000. So every time we will multiply this value, the miles driven for specific year multiplied by 0.18 mile, and that is our depreciation rate, and that is constant for each year. So this is our production method of depreciation. So now in the last we have modified accelerated cost recovery system. This is very simple. Actually, this is the system is depreciation method required by the internal revenue service to be used for income tax calculation purpose for most plant assets placed in service after 1986. Okay, here we don't calculate the depreciation rate. It is this rate is implemented by the department internal revenue service of any other financial agency. So we don't calculate this rate could be different for different classes of equipment or assets. So in this case the depreciation rate is given by the department. For example, we have a printer of original cost $2,000. It has a property class 5 year. So for year 1 the rate was $20, 20%. For year 2 it was 32%, and this is set by the department. We didn't calculate it. For year 3 it was 19.2%. Okay, so how did we calculate the depreciated amount for year 3? We just multiplied the original cost with depreciation rate provided by the department, and we have the annual depreciation rate for year 3, and that is $384. Okay, so in the very same way we have calculated the depreciation rate for each year. We just multiplied the original cost with the depreciation rate for each year. Okay, so here is the difference in this method. The depreciation rate total accumulates for 100%. So the total depreciated amount will be $2,000, 2000, that, and that is original cost as well. So there is no depreciation, salvage value. In this case there is no salvage value. The department has depreciated that equipment by 100%. So that depends upon the department. It could be like it could be less as well, but in this case the depreciation rate is overall for 5 years is 100%. It could be 90, 80, whatever department wants. So this is the last, the procedure or the method to calculate the depreciation. So that was all from my side. If you have any question, you can comment any question. Thank you.